Happy November, where bad economic news is good news for the stock market. I'll show you exactly what I mean. Just yesterday, we got the latest job market report, which said that the United States economy added just 12,000 jobs in October last month, while economists were hoping for 100,000 jobs to be added. A big difference. And then after that, we got the latest manufacturing report, which said that manufacturing activity in the United States has now fallen to a 15-month low. The stock market heard these two pieces of bad economic data and they got very excited. We saw stock markets rallying because traders are hoping that this bad economic news is going to mean that the Fed is going to cut interest rates and that the Fed is going to continue stimulating the economy and stimulating the stock market. If you don't believe me, here's what Yahoo Finance had to say about this. Quote, as of Friday morning, yesterday, markets were pricing in a roughly 99% chance that the Fed cuts interest rates by 25 basis points next week, up from a 95% chance just a week ago. So Wall Street is pretty much convinced that the Fed is going to cut interest rates next week because we got this bad economic data, and that's why Wall Street is excited, because they're hoping that bad economic news is going to continue stimulating the stock market. And so what I want to talk about today is, number one, what's going on in the job market, number two, what's going on with manufacturing, and number three, what's going on with the Federal Reserve Bank and how you can find the opportunity, because that's what savvy investors do. Starting with the job market. Yesterday's job market report that we got is the last major economic report that we're going to get before the election and before the next Federal Reserve Bank meeting. The Fed is going to announce on November 7th what they want to do with interest rates. And of course, we all know that Wall Street is now convinced that the Fed is going to cut interest rates again. But the job market report said that the United States economy added just 12,000 jobs last month, which is a whole lot less than the 100,000 expected jobs. And the reason why is because many people are saying it has to do with strikes and hurricanes. Here's what Indeed had to say about this. An economist at Indeed, quote, at first glance, October's job report paints a picture of growing fragility in the United States labor market. But under the surface is a muddy report rolled by climate change and labor disruptions, meaning hurricanes and strikes. While the impacts of these events are real and should not be ignored, they're likely temporary and not a signal of a collapsing job market. So although the job market data is so bad, blame it on the hurricanes, blame it on the strikes. We'll see what actually happens with it, but we all know that many Americans, even if they have a job, many people are underemployed. We have a lot of people with college degrees that are not working college-level jobs, and we have a lot of people who feel like they're not earning enough money to keep up with the growing cost of living due to inflation. However, the bright side of this job market report is that the report said that salaries and wages have been rising a little bit faster than expected. So if you haven't gotten a raise recently, maybe it's time to ask your boss for a raise. Which brings me to the second thing that I want you to understand, which has to do with manufacturing in the United States. Now, like I said earlier in this video, what every savvy investor does is not get emotional through this sort of data and these reports. They want to find the opportunities. More specifically, they want to find the investment opportunities, because savvy investors know how to win in every stage of the market. And if you want some assistance with that, that's why I created Market Briefs Pro, which is a more exclusive newsletter for stock market investors who want help finding these investment opportunities through research, through data, through analysis, because we go and we search for market shifts that were happening. So if you're a stock market investor and you want to learn about how you can stay on top of these market shifts and you can learn about these investment opportunities, you can learn more about Market Briefs Pro by clicking the link down in the description below. And then there's a short video that you can watch that will walk you through what Market Briefs Pro does. If it sounds interesting, then you can sign up for a content demo and see if it's right for you. Now, when it comes to manufacturing, what we got yesterday is a new manufacturing report which said the United States manufacturing activity has slumped to a 15-month low in October. And a big reason for this has to do again with the strikes. There are 33,000 striking workers at Boeing. And this is where now the question is, how deep do we want to look at what's going on with Boeing? Because obviously there's been a lot of strikes happening recently. We all remember the port strike that happened not that long ago. And now we have this ongoing Boeing strike, which has an impact on the Boeing company, on the economy, and the salaries and incomes of these 33,000 workers. But just yesterday, Boeing put out a new proposal to hopefully end the strike. Now, we're not going to know until a deal is reached or not, but what Boeing said is now that they're willing to boost wages by 38% over the next 4 years and offer an improved $12,000 ratification bonus if the striking workers accept. Now, we'll see what happens with that. Obviously, Boeing wants people to get back to work so they can continue running their business, but that's one of the reasons now why manufacturing in the United States has been impacted. Now, the reason why this is interesting, the manufacturing work particularly, is because you might remember, if you've been watching my channel, if you've been watching market briefs, you know that a couple of months ago, a bad manufacturing report is what triggered a big stock market sell-off. It was when they had that big 1,000 point sell-off day in the stock market. It was because we got a bad manufacturing report. Now we got an even worse manufacturing report and we saw markets go up. So the question is why? And this is where, if you are a fundamental investor, you're probably scratching your head because you're getting bad economic news and markets are rallying because markets are hoping that the Federal Reserve Bank is just going to keep stimulating and pumping up the markets. And this is where, like I said before, if we talk about the Federal Reserve Bank, we now have a 99% chance, or markets are pricing in, a 99% chance that the Fed is going to cut interest rates by 25 basis points, which is 0.25% next week on November 7th. Now, what we do know is that the Federal Reserve Bank generally does not like to disappoint Wall Street. At least that's what it's been since the pandemic. The Federal Reserve Bank talks about how they feel comfortable cutting interest rates because they no longer feel that inflation is a worry and because they want to continue stimulating the economy and the job market. Now, unemployment is still 4.1%, which is historically still some of the lowest unemployment ever. And inflation is still around. It's still a problem. So now the Federal Reserve Bank wants to continue stimulating even though inflation is still around. And the job market, if we look at the reported unemployment numbers, show that there's no problem in the job market. Now, of course, we know that if you dig a little bit deeper, there's a lot of concerns in the job market, like we've talked about. You have a lot of people that are no longer qualifying for unemployment because they've been out of work for so long. You have a lot of people that are underemployed, people that are working at McDonald's when they have college degrees, for example. We know that a lot of people are working multiple part-time jobs. And many people are working jobs that are not within their skill set or their career because that's all they can land on. And so this is where the question is, what is the Federal Reserve Bank really looking at and who are they really looking to benefit? And at the end of the day, my belief is that our economic system is designed to benefit the investor. And if you want to now win in this economic system, you have to shift your mindset from just being an employee and a consumer to being an investor. Now, nothing wrong with being an employee. Nothing wrong with being a consumer, but there is something wrong with being just an employee and a consumer and not an investor because our economic system is designed to benefit the investor. For example, the CEO of your company has a fiduciary duty, not to the customers of your company, not to the employees of the company, but to the shareholders of the company, the investors in the company, the owners in the company. So the CEO of your company is working to drive up the value of your company. They're working to drive up the profits of the company because that's their duty. Your CEO's duty, their allegiance, their goal is to keep the shareholders happy. Who are the shareholders? The shareholders are the investors. And so we have this whole economic system where you're working to get a job and the goal of your job is to increase the profitability, is to increase the valuation, is to increase the value for the shareholders. And so if that's the game, you have to become an investor. You have to be a shareholder. You have to be one of the people that's benefiting from the system because that's how the system works. Not just that, we know that the Federal Reserve Bank is in the business of producing inflation. It's not that the Federal Reserve Bank says that they want 0% inflation. They say that they want 2% inflation. Now, the problem is we saw this big period of very high inflation the last few years. So now when you hear that the rate of inflation has fallen, people are celebrating at the Federal Reserve Bank, but the average person is saying, hey, you're saying inflation has fallen, but everything is still so expensive. And the reason why is because when you talk about disinflation, that means the rate of inflation is falling. It does not mean that the prices of things are falling. It means that the prices of things are rising less fast than before. And so what the Federal Reserve Bank says And what every economist says is the reason why everyone is happy is because now reported wage growth is faster and higher than reported inflation. Now, if we just stick with that assumption for a little while, the goal then is to see reported wage growth to continue to outpace inflation so people's incomes can eventually catch up with inflation. But that has never happened in the past. We've always seen inflation benefit the investor more than the employee and benefit the investor more than the consumer. In fact, inflation doesn't benefit the consumer. Inflation hurts consumption. Inflation makes consumption more expensive because that means you got to spend more dollars when you go out to eat. But it benefits the investor because that means that the companies that are selling you the food are making more dollars in profit, and those profits go to the investor. This is why it's so important for you to be financially educated. This is why it's so important for you to understand how the system works, because you can get these crazy reports of bad economic news and the stock market rallies. Now, of course, markets go down. We know that recessions are part of our system. We know that market crashes are part of our system. But what every savvy investor does is they plan. They plan to take advantage of these opportunities. They want to know how they can win when times are bad, and they want to know how they can win when times are good. But this requires you to have money to invest, understand the game, and then actually be able to find those opportunities. Now, there's a couple things that you can do to help. Number one is invest in your financial education. Read books, listen to podcasts, watch YouTube videos, learn to read a financial statement, learn to underwrite real estate deals, learn how to value an investment. Number two, stay up to date on what's happening in the economy. Market Briefs is a free resource where my team is breaking down what's happening in the economy. The link to Market Briefs is down in the description. And then if you want to go even more above and beyond, if you want to stay on top of financial trends and you want to stay on top of market shifts, that's where Market Briefs Pro comes in, which is more advanced newsletter where we go into those types of shifts. And again, if you want to learn more about that, we have that link for you down in the description as well.